Welcome to the second episode of this experiment that I'm going to conduct. Basically, in this video, I want to talk about a little bit of what it is to own a stock. I want to cover what is an index, what is an ETF, and just the basics so that anyone that doesn't know much about stocks can start to follow me in the next episodes, which will become more and more complex. So I want to start with the basics, so bear with me, my regular members that know all about the stock market. Let's get started. As far as I know, the Dow Jones Industrial Average Index is the oldest one of all the indices. I believe it started at the end of the 1800s or beginning of the 1900s. Don't quote me on this, but basically it used to represent 10 industrial stocks, and the goal was to try to represent the state of the stock market or the economy as a whole, if you want, back in the old days. And Charles Dow was the one that created this. And then from there, it evolved. Right now, it includes 30 industrial stocks. Since then, there's the S&P 500 that has come to life, and then there's the Nasdaq, which is represented by the QQQ. So this is the Dow Jones. It started here on the charts. Like, let's go back and find out. 1897 is what I see here. Maybe it started a bit earlier, I don't know. But this is the recorded dates, and you can see that even though it's been around for a long time, it had its series of ups and downs through history. 89% down. This is the period of end of 1960s to 80s, where the stock market was basically flat, really high inflation, which is kind of similar to what we're living and are going most likely to live in the next decade. And this was considered to be a lost decade, and then eventually the market started to pick up again. So now it's been going up for a while. We've had the 2000s have been very good for the stock market. Of course, there had been a couple of bleeps, like a 54% drop in 2008, 2009. We had the COVID, which dropped the market. Well, this one 38%. And what you need to know is that when a company goes public, it can issue shares that shareholders or wannabe investors can purchase. For instance, let's say you want to invest in Microsoft, for instance, then you could buy a share for $517 and be a shareholder of that company. And whenever the company has earnings or makes profits, along the way, it can invest into its infrastructure, create new products or services that client want, and then it can increase its share price over time. And then if you sell the share at a higher price than what you paid for, then you make money. The other way that you can make money through investing into stocks are dividends. Usually, not always, but most high dividend companies are mature companies that have kind of saturated, and they're at the end of their growth phase, and now they don't know really what to do with the capital. So they start to give back to the investors the capital because they don't know how to allocate it in order to grow bigger. It's not always the case. Some companies have been around for a very long time and still have a very low yield. Microsoft is one of them at the 0.63%. This is very low. If you compare it to a company, I don't know, maybe Enbridge, this company has a 5% dividend, which is much nicer for a person that wants to have some income. So a retiree will try to find some dividend stocks in order to live off of them. This is the S&P 500. It represented by its ETF because you can't directly invest in an index. They're like representations of multiple stocks, like a benchmark if you want. But you can invest into an ETF, an exchange traded fund, that is composed of the stocks that are represented by an index. Confusing maybe, but basically a company can decide to reproduce or clone the benchmarks, basically. So the S&P 500 is composed of 500 companies, of the biggest companies in the United States. The Dow Jones Industrial Average is composed of 30 industrial stocks. And the NASDAQ is composed of a bunch of technology companies and is a bit more volatile. It's the most volatile of the three. And then there are a bunch of other ones, other indices that are represented by ETFs in which you can invest around the world. So, for instance, in Canada, we have the TSX, the Toronto, on the Toronto Stock Exchange, and you can purchase ETFs that are that have different fee structures. So when you invest into an ETF, it's really important to look at the fees that you are paying because these can erode your profits over a long period of time. If you want to learn more about ETFs and you want to compare the fee structures of them, then you can go to ETF.com. You can press on this. And then you can go, let's say I want to learn about the SPY. I'll pick the SPY over here. And here, there's a couple things you need to consider when you invest into an ETF regarding fees. First of all is the MER, so the management expense ratio. Sometimes it's just called the expense ratio. And there's also, you need to consider the commissions that you pay with the broker that you're going to use, and also the tracking it's called the NAV, of the net asset value, basically, because sometimes they will be lagging, and this can affect your results over time. If you're just a casual investor, this is not really relevant, but it can make a difference if you hold something for 30 years and there's a few basis points difference. It can make a difference over time. So let's say you're here and you want to learn about the SPY. You can look at the holdings. These are the top 10, but you can do a view all, and you have every single stock that is inside of the ETF, and you can have the percentages. You know exactly what you're investing in. Sometimes I also use this website in order to find stock ideas, because there's so many different ETFs that are aside from the indices. Basically, they're like micro categories, and you can find some really good investing or trading ideas if you compare the charts. Some people look at the numbers. I'm more of a chartist than I am a fundamental investor, but to each his own, I guess. Another thing I want to touch on is if you go to overview and then you go down a bit, there is a section here called compare ETFs. And if you want, let's say we compare to the VU, this is a very well-known ETF from Vanguard, which has low fees, and you press compare, then you have you can tell the differences between the two. So they weren't created at the same time, so the percentages will vary slightly regarding the stocks and the number of holdings and things like that because of lag. But basically, it's the same stocks that are represented by these ETFs. And here you can see what I was talking about, the management expense ratio, the MER of 0.09% for the SPY, and VU is 0.03%. So it's a third of the fees, even though these are very, very low fees. Back when the concept of investing into multiple stocks into one single purchase was created decades ago with mutual funds. The fees could reach 2-3% sometimes. That really erodes your money over time. But when you're talking about 0.09% a year, it's very insignificant. So this is a great way for a starting investor to just purchase 500 stocks in one single transaction. So you have instant diversification. And as there are new winners, like for instance, right now, the darling of the market is NVIDIA, then you have exposure to that stock because it goes up in the ranks of the ETF. So for instance, here, if you compare SPY and VU, you have NVIDIA as the first. Like I was saying, the percentages will vary because of tracking errors and starting dates and things like that. But more or less, it's the same companies that are in the top 10, but sometimes the order will change. For instance, here, Broadcom and Alphabet are kind of misplaced here. So that's what I wanted to talk about. This is a really great website, I think, to learn about and compare different types of ETFs. When comparing these ETFs, you can look here at the different sectors that the stocks that are within the ETF are concentrated in. So for instance, here, the highest sector is electronic technology and technology services, finance, retail, and it goes back to transportation being the smallest. So I'll show you another website that I use sometimes to find stocks. So this is a sector spdrs.com, a sector tracker, basically. And what it does is it separates the S&P 500 into its 11 sectors. So you have each of these are ETFs. So you have XLC, which represents the communication services within the S&P 500. XLY, the consumer discretionary. These are more sensitive. For instance, discretionary, if you're in a recession or something like that, it might go down because people are stop going to Starbucks, for instance, because they don't have money anymore to buy a coffee or something like that. I'm not even sure if Starbucks is a discretionary, but it's just an example. Consumer staples are considered in there are three defensive categories in these 11 sectors, and consumer staples is one of them. It's one of my favorite sectors to invest in because staples are basically what you find in your grocery store. And they are very defensive because even though we might be in a recession, people will still need toilet paper, basically. Energy, get your oil and gas in there. You get your financials, the banks, the insurance companies, and things like that. Healthcare, everything that has to do with pills, vaccines, and things of that nature. You get the industrials, which are stocks that you might find as well that might overlap with the Dow Jones. You get your materials, so anything that has to do with gold, silver, nickel, everything in that to make batteries and things like that is going to be in that sector. You get your real estate, technology, and utilities. And what I like about this website is that if you click on this, you have every stock. There are 37 consumer staples within the S&P 500. So what I do sometimes is I go down the list of all of these stocks and I look at the charts and I figure out if there's a company in there that I'm interested in buying. So what I want you to remember from this page here is that the S&P 500 is divided into 11 different sectors. These sectors are also subdivided into subsectors, which you can investigate with the help of Google. And there are 3 categories in there that are more defensive than the other ones, and these are consumer staples, healthcare, because people will keep buying their pills even though there's a recession, and also utilities, because people will still pay for their electricity, for instance, or water bills and things of that nature. So if you're a bit nervous about the overextension of a price move in the stock market, like we are now, then these are places where I will go to investigate to try to find stocks that have lower volatility or lower beta than the stock market in general, basically. All right, so now let's talk about what it is that you can invest in as far as ETFs if you wish to have exposure to the S&P 500 and you are in the United States. So the first one is the SPY, SPY. This one is, I believe it's State Street that is that has that ETF. And the other one is VU, like I discussed earlier. This one is from Vanguard. And then the other one is IVV. This one is from iShares, which is BlackRock. So State Street, BlackRock, and Vanguard are basically the 3 places where you will find ETFs that have the lowest fees. So you need to do your own research as far as fees. If you are in Canada, then VFV on the Toronto Stock Exchange is basically your go-to. There are a few options as well. If you want, this one is unhedged to the US dollar, but you could use VSP as well, which is hedged. So if you're worried about a battle between the two currencies, you can use that. There's from iShares, there is XUS. Another one with low management expense fees. The hedge version, I believe, is XSP. Yeah. And then you have one from the Bank of Montreal, which has slightly higher fees, I believe. You need to check on that, but ZSP is another option if you want to avoid conversion fees and you want to stay in Canadian dollars. If you want the exposure to the Nasdaq, the flagship is basically QQQ. Called the Qs, basically. This one tracks the Nasdaq 100, which is 100 technology stocks, excluding financials. And if you want the Canadian dollar equivalent, you can go with the XQQ on the Toronto Stock Exchange, which is the a replica but in Canadian dollars, and it's hedged as well. Another provider is QQC.F, I think. Yeah, from Invesco. It tracks the same thing, and BMO also has ZNQ, which is the same thing as well. And lastly, if you want to invest in the Dow Jones Industrial Average, if you want to study it, it's DJI, which is the index. So you can go really far back in history. But if you want to invest in US dollars into the Dow Jones, then it is DIA that you can invest in. You see the history is not as far. So that's how you do it in US dollars. If you want to invest in it in Canadian dollars, BMO has an option with the ZDJ where it's listed in Canadian dollars. So what about performance? So if you go to stockanalysis.com and you click on stocks and comparison tool, we can take a look at them. So we got DIA, which is the Dow Jones. We've got the SPY, which is the S&P ETF. And then we have the Qs, which is the NASDAQ. So now this is going back in time and looking at what you would have made as far as returns. The clear winner is the NASDAQ, followed by DIA, but very close, and then the S&P 500. And this is all, you know, if you, this might move a bit if you change your window, if you look back in time. So again, diversification is key. You can't, it would be very hard to go broke over a long period of time based on historical data. But you never know, you know, times may change and maybe the stock market is going into another lost decade. So you never know when you invest. So that's why you need to invest money only that you can afford to lose or at least not need for a very long time, at least 5 years if you're going for index-based investing. And then that concludes this video. So I hope that you guys enjoyed. If you're a beginner, and my apologies for my old school old timers that have been watching this video. This is very basic, but I think it's the foundation that we need to build in order for everybody to be able to follow the series I'm going to go through in the next few months.